Let's kick it around. In today's closing bell exchange, Beth Lilly from the Belly Funds is with us today. Ken Mahoney from Mahoney Asset Management. Ed Dykey from JHS Capital Advisors. Michael Gapan from Barclays, and our own Rick Santelli. Let me bring out, just in the last few minutes, gang, the White House came out and said that the annual budget deficit will fall to $583 billion, much lower than last year. And they say that next year, the deficit will be below 3% of GDP. Beth Lilly, I guess good news. It's not moving the market today, but gradually,
good backdrop,
incrementally, we just keep getting better on the finances, don't we?
Absolutely, and I would contend, and we contend, that the economy is definitely improving. It's slow, but we're getting traction, and all the signs are that things are improving. That we see employment back to pre-recession levels. That 8.7 million jobs that we lost have now come back, but they're in lower wage jobs, and so you're seeing a slower consumer. But we do believe that there is traction in the economy and things are improving.
Ken, do you agree with that at this point? I mean, because we have seen better jobs reports lately, yet there seems to be a large disconnect between Main Street and between Wall Street, and that seems to be widening.
Yeah, it's been that way for a while. This is going to be a tug of war for the bulls and bears for the next couple of weeks, no doubt. And, if you kind of look at it here, history is on our side here. 2/3 of companies that report typically report where they meet or exceed earnings expectations. Now, this has been a tough week, no doubt. But I think the market still has a lot going for it. There's still a lot of cash sloshing around. You still have underinvested bulls. And you still have a lot of money managers kind of have this performance anxiety. So, granted, not a perfect market, but we'll still go with the choppy market, but with an upward bias.
Mm-hmm. But even as we wonder about the health of the economy, there are those who fear that the easy money policy will start now to fan the inflation flames. Finally, Ed Dykey, PIMCO is out saying it's time to buy TIPS, the Treasury Inflation Protected Securities. Would you agree with that?
No, I'm not a bond buyer at all. I prefer equities over bonds every day of the week. And I think, the thesis that PIMCO has had for a long time, which has been, quite frankly, a very good thesis, the new normal, that we'd have slow growth, low interest rates. I think they're in the ninth inning of that call. And I think the opposite is happening right now. I think the economy's picking up. I think it's picking up more than people expect. And I think the thing you have to ask yourself, the consumer isn't buying, but you know who is? Corporate America. Corporate America's buying everything in sight. They're buying back their own shares. Right. They're buying other companies. And now,
that's why the earnings per share looks so good.
What was that, Rick?
That's why the earnings per share metric so often quoted as a great positive. If they bought back all their stock but one share, their earnings per share would be through the roof.
Yeah, Michael, what about that? Because there are those who are saying that corporate America is not growing from the bottom line. They're using their bottom line to buy growth. And therefore, you have to look at the earnings and the metrics a little differently. Do you buy that argument or not?
I do. At least they're doing something to improve that bottom line. So activity is better than not doing something. I agree with the basic flavor that everybody has presented, that soft growth doesn't have to be fragile. Soft growth and moderate growth will get it done over time. That equities are likely to bubble higher, and a combination of corporate activity on the balance sheet as well as a gradual improvement in fundamentals will keep earnings per share doing well and equities likely bubbling higher. So I would just echo the sentiment that you've heard from the other guests so far.
I don't know if we want to use that bubble word.
Well, we have been.
I don't know, Michael, about that. I mean, I know what you mean. However, I'm a little worried about it.
That's a very fair point. Very fair point.
Hey, Rick, for some reason I thought of you when I saw those budget deficit numbers come over the wires just a short time ago.
I'm glad you did, Bill.
Yeah,
I'm glad
I
because
know.
you know what? Everybody's crazy. Okay? Here's the analogy. A family of four has a dozen credit cards that are maxed out, and they put them in the bureau drawer. That's our $17.6 trillion debt. On their new credit card, they're way below their limit. That's the United States of America right now. Yes, it's a great improvement. We had 08, 09, 2010, over $1 trillion deficits. Now they're getting in line with where they were in the Bush administration going back. Definitely a huge improvement. But the fact of the matter is, until it goes into surplus, the tail we're dragging along, which is approaching $18 trillion, is not getting smaller. And the Office of Management and Budget and the CBO both agree on one thing. Once we hit around 2017, it all goes back the other way.
So, I mean, you don't buy the notion that you can only turn the ship slowly. You can't turn it on a dime. I mean, we are improving, though.
Oh, no, I agree. It's an improvement, just like jobs are an improvement. Right. But when people wonder why the economy's underperforming, it's because we can't differentiate between a big debt we're carrying and smaller deficits, or the fact that a credit card isn't really income, it's debt.
Yeah.
And Ed Dykey, this still doesn't make you want to buy tips?
No, it doesn't make me want to buy tips at all. You know, the one thing that's happened is everybody said when the government started spending less money, they wouldn't hire anybody, and then unemployment would get even worse. But what's happened? Corporate America stepped up and has started hiring people. In fact, corporate America is complaining that they have a lot of positions to fill, but don't have qualified applicants to put into those positions. So I think job growth is going to continue to be stronger than people anticipate, and I think that's going to be the engine that's going to drive the economy and eventually start to turn around these deficit numbers over a period of time. And you're right, it's not a speedboat, it's the Titanic. Bad analogy, but nonetheless, it's a big ship, not a small one. It does not take a short period of time to turn around.
Yeah, I think one of the common denominators we're speaking about today is that balance sheets of corporate America, which have a lot of cash. And in boardrooms across America, they're looking at how to deploy that cash. All of it is shareholder friendly. So whether they buy back shares, raise their dividend, or buy other companies, or all the above, is very shareholder friendly. And that's a very positive for this market.
Right. You know, Beth, though, I worry a little bit that there are some valuations out there that are stretched. Do you view the market as undervalued, fairly valued, or slightly overvalued?
I would still say fairly valued.
Let's ask Beth. How's that?
I would say that the market is slightly undervalued. I mean, we saw a big year last year, but we're still finding areas to put money to work. You know, Carl Icahn was out today talking about being very selective with investments, and I would reiterate, you know, we're using the dips to buy stocks. We think it's slightly undervalued but not overvalued because
what are you buying, Beth? What are you buying?
There's two stocks I want to talk about, BioScrip and Orbcom. BioScrip is a home infusion company, new CEO. He's come in, he's expanding the EBITDA margins, he's cleaning up the company. There's consolidation in the industry of the home infusion, and hospitals are trying to push more people out of the hospital into home care, and BioScrip is a direct beneficiary. And the other one is Orbcom, which is a satellite company that's transitioning to a telematics company. They're about to launch a bunch of satellites. You're going to see a dramatic acceleration in EBITDA. Margins are going to expand, and we think both of those stocks can double over the next several years.
Classic Gamco's compelling story stocks. That's all I can say.
That's exactly right, and totally misunderstood by the market.
Okay.
Michael, final word to you, if you could. Is the market underestimating the Fed taking away the stimulus, the October date? I mean, I hear a lot down here about the fact that they're worried that the market is complacent. Even though they know the punch bowl is going to be taken away, there were a couple of Fed members out today who said the market's underestimating how soon that's going to happen. Does that worry you?
Michael?
Not as much, because I would say even that worry that it's going to come sooner than you think. The Fed's been clearly communicating where this is a tightening cycle that's going to start later and be slower than normal. So even though it may start a bit sooner, on balance, it's still going to be more accommodative than they would have been in a regular tightening cycle, and that's generally positive for stocks. So I would say that it's a worry, but if you have a long enough time horizon, it shouldn't be too much of a worry.
All right. Thank you, folks. Appreciate you stopping by. Have a good weekend.
Thank you.
Thank you.
See you later.
Thanks for
Heading toward
having
the
us.
close. We've got 50 minutes left.